The Indian real estate sector is headed for normalcy. Fueled by attractive home loan rates and availability of inventory, sales are now showing a consistent growth. In a recent interview, HDFC Chairman Deepak Parekh said he has not seen housing demand for affordable and mid-income segments the way it is today in his 44 years with the mortgage lender. In fact, according to real estate consulting firm CBRE, housing sales in the first 3 months of this year jumped almost 40% year on year to more than 70,000 units. Another property consultant, Anarok, reported housing sales in the March quarter were at their highest level since 2015, with approximately 99,550 units sold across the top 7 cities of India. Ravi Subramanian, MD and CEO of Shriram Housing Finance, said the demand for housing is immense in the affordable segment and the sector has barely scratched the surface. Anarok data shows that unsold affordable housing stock declined 21% in 2 years to 1.86 lakh units. Meanwhile, home loans are set to get costlier. HDFC increased its retail prime lending rate, on which its adjustable rate home loans are benchmarked, by 5 basis points. This comes after many large banks, including the SBI, increased their marginal cost of funds based lending rate by 5 to 10 basis points last month. An increase in the Reserve Bank of India's repo rate is on the anvil, marking a turn in the interest rate cycle. At the same time, builders have no option but to pass on the input cost inflation. Data shared by Macrotech developers shows that commodities like cement, steel and tiles have seen year-on-year cost escalation of as much as 35.1%. However, the weighted impact is about 13.7%. While inventory prices have already gone up by 6% last fiscal, they are set to rise another 6 to 8% this year, which is below the expected average wage growth of 10% in India, based on a survey by Aon for FY23. The rise in average wages will enable real estate players to pass on the cost increase to customers and maintain margins. Macrotech's MD and CEO Abhishek Lodha, at the fourth quarter earnings call, said that modest price growth in fact bodes well for the sector as the company expects inflation to moderate.
We believe that too much price growth is harmful and too little price growth is very, very harmful. In the few years prior to COVID, when prices were flat and then declining, volumes fell significantly because nobody really wants to buy an asset which is falling in value or not appreciating in value. On the other end of the spectrum, if price growth is significantly higher than wage growth, then you have affordability issues coming up and volumes can get impacted, especially in the affordable and mid-income part of the business. What we are seeing right now is kind of a very, very happy situation where price growth is happening, in a manner which makes the home buyers believe that their asset is appreciating in value, which is great. It also makes potential home buyers make their purchase decision earlier because they know that in the future the asset will be more expensive in nominal terms. And overall, the increase being below wage growth, so if you have wage growth of 8 to 10% and price increase of 6 to 8%, affordability increases from a financial perspective, and therefore more and more people are able to climb onto the housing ladder. So all in all, we have seen that consumers welcome a modest level of price growth, and it encourages home buying, and it also improves significantly the sentiment amongst those who are already home buyers.
Experts also indicate that the pandemic helped shift consumer sentiment heavily toward homeownership, and the work-from-home trend is boosting demand for larger homes. Vivek Rathi, Director of Research at Knight Frank India, said that the sustained sales momentum post the third coronavirus wave shows the sector is under a new upcycle.
The residential real estate made a very strong comeback after the second wave, and this growth was primarily led by end users. And the end users flocked the market because of two factors. Number one, the interest rates were at record low. And second, the developers kept the price at a reasonable level. They did not randomly increase the price when they saw this recovery happening in the market. And in fact, that led to a good affordability in the market. And we saw the home buyers going ahead with their purchase decision. Unfortunately, with this COVID-19 situation in China, as well as the ongoing war in Ukraine, the supply chain has again been disrupted, which has led to an upward pressure on the input cost. Now, the developers are, I think, or will be very soon forced to increase the price. Now, it is yet to be seen what is the percentage hike that a developer can pass it on to the buyers, and what is that percentage hike that he can absorb himself. In my opinion, anywhere between 5 to 10% of price hike will be acceptable by the buyers, because still the market is very price sensitive. But again, having said that, the buyers also have evolved. They realize the fact that the input cost has put an upward pressure on the pricing of the developers, and they have no choice other than by passing on certain amount to the home buyers. The home buyers are still finding this market quite lucrative because it is being driven by grade A developers. The affordability quotient is still very attractive. Though the interest rates have started to inch slowly, they are still at on the lower side, and in my opinion, this will not be a big dampener for the home buyers.
While high raw material costs and the ongoing Ukraine-Russia war are likely to be a near-term damper, the industry estimates that the risks due to rising inflation and mortgage rates are overstated. All signals now suggest that residential real estate is heading for a structural growth cycle after years of downtrend.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.